Hello, everyone. I am Fyruz Khan, and today I'm back with a brand new class. If you haven't liked our Facebook page, just go to Facebook, type in Fyruz Education Services, and subscribe to our channel. We have plenty of videos, detailed explanation on business studies chapters. Also, you can subscribe to our YouTube channel. You can see the banner scrolling through down the screen. Again, just type in Fyrus Education Services. The good thing about YouTube is that everything is synchronized on a playlist, and it's very easy to find. We have around 75 videos on YouTube. So yeah. Let's wait for some students to join. Today we have a very interesting session designed. Let me tell you before we start, it is going to be a long class today. We're going to finish this chapter today. So yeah, let's go ahead. So this is a picture of me and my friends. This is my elder sister. This is my wife, and these are my friends. And recently, it was my wife's birthday, and we had great fun in our house. We had barbecue. We had great food. It was cold that night, and that's why we enjoyed a lot. The food was amazing. We had a pretty good time. And I also got this opportunity to interact with my friends a lot, which I don't do usually because mostly I'm busy with work. So I spoke to this friend of mine right here. He's Navid. He's a very close friend of mine, okay? And he's a great guy. So I spoke to him, and we spoke mostly about businesses. So he was telling me that the marketing budget for his company in 2019 was 30 lakhs. Now he has a freight forwarding company. Now let's talk about what is freight forwarding company. It's like DHL, it's like FedEx. They will help you to ship items. For example, I'm trying to get some furnitures from America, so his company is helping me to bring those items here. They will tackle the problems in customs and everything, and they will ship it to your doorstep. So he said the marketing budget for 2019 for his company is known as Crown Container, was 30 lakhs. Okay. And then I told him, because the situation is very different now. I asked him, what's the budget for this year? What was the budget for 2020, or next year? And he said it's very low. It's 20 lakhs. And I asked him why. He said, we looked at the budget last year. Yes, it was 30 lakhs. Okay. But for 2020, it's low because the business environment has changed. He also added that the economic environment is not the same anymore. The budget for 2019 was 30 lakhs, the marketing budget, but that does not mean that it will be the same for 2020. Yes, you will have an idea what was the budget like in 2019 and go forward with that, but then the situation changes. Everything is different because external environment is not constant. So you may take an idea from your past budget, but you have to be careful that the future is not certain. External environment is not constant. So you can look at the past to get an idea, but the business environment in the future will be different. Um, and this kind of budgeting is known as incremental budgeting, where you look at the past, but then when you go forward, you look at the situation, the external environment, the business situation, the economic situation, the financial situation. So the marketing budget for 2019 was 30 lakhs, but for 2020 it's 20 lakhs. It went down because of pandemic, because the situation is different. Last year it was 30 lakhs. That does not mean that it's going to be 30 lakhs again. Okay. So incremental budgeting looks at the environment, looks at the change, right? Um, because because you have unforeseen events, you can use last year's figure as a basis, but then you have justify it. okay? Because the business situation will be different in the future, and that is incremental budgeting. Then moving forward again, let's say the marketing budget for your company in 2019 was 30 lakhs and the marketing budget for 2020 was 20 lakhs, okay? So what you can do is the other way is the company will not look at the situation. The company will look at, okay, why do you need 20 lakhs? You need to justify the reason. Okay, you need to justify the reason and minimize cost. You look at everything. So if you ask for 20 lakhs, if you ask for 40 lakhs, what's the situation with the business environment? They don't care. They will look at, okay, why do you need 40 lakhs? Or why do you need 30 lakhs? So you need to go on and justify. However, this is time consuming. Okay, this is very time consuming. And this kind of budget is known as zero budgeting, where you justify the reasons of whatever money is required or whatever budget is required. Okay, that is known as zero budgeting. Now, zero budgeting, the concept is whatever cost you have and the revenue, it should be equal. And that's why the name is zero budgeting. Okay, the money you spend in a company and the money you earn in a company should be somewhat equal. It should be equal. And that's how the name comes, zero budgeting. Okay, when it's equal, it's zero. You neither make profit, you neither make loss. Okay, so let's say if your cost is 25,000, your revenue should be around 25,000. And here they don't look at situation, they look at why do you need it. You have to justify the reason. And zero budgeting mainly aims at minimizing cost. It is a very cautious approach. Of course, they don't look at the past. They don't look at extrapolating numbers from the past. They won't look at past because their idea is the past is gone. The data that you will have in the past, for example, marketing budget for 2018, 19, it's dated, it's outdated, it's stale. Because now for the coming future, the situation is entirely different, especially in times of pandemic. Okay? And zero budgeting focuses at minimizing unnecessary purchases, unnecessary costs. It will look at everything with a magnifying glass. Okay. Also, the concept of opportunity cost is linked. Now, let me further go and discuss this forward. Now, opportunity cost means, let's say you have option one. Option one is you can spend 5 lakhs on marketing, or you can buy new computers for the design team with 5 lakhs. So if you go for option one, the option that you have left is your opportunity cost. Or if you go for option two, the option that you didn't choose, which is option one, that is your opportunity cost. Now, zero budgeting, what happens is that they try to minimize this thing. Okay, what they will do is, because usually what happens, whether you need option one or option two, depends on priority. If you think marketing is priority, then spend on marketing. If you think buying computers for the design team is priority, you buy computers for the design team. That's how you take decision in business. You look at priority, which is required first. But then there is this other way. You can choose in terms of priority. You can also do somewhat of compromise. Okay, instead of spending 5 lakhs on marketing, let's spend 2.5 lakhs on option one, which is spend on marketing, and spend 2.5 lakhs to buy computers for the design team. So you have both the options, but yes, you are making a certain compromise, and therefore you're minimizing opportunity cost. So that's what zero budgeting does. Zero budgeting does not leave any options. They always try to minimize opportunity cost. They look at a magnifying glass, okay, and that's what they do, right? So there we go, and that's zero budgeting. If you have any questions, please do not hesitate to question on the comment section, and we will take your question as soon as possible. We have 2 comments. Let me go and check. Samail says, hello, bhaiya. Hi. Anika, hi. Thank you for watching our video. Let's go ahead. Let me just, okay, right. Now, so zero budgeting is basically you have to defend your work. Why do you need that money? You have to tell them, justify it, okay? But however, it is time consuming, right? So that's the only problem that I can see. Um, Next up is flexible budgeting. Now, flexible budgeting, as the word suggests, the budget is flexible. It may go up, it may go down. Now, it depends on the output. For example, if I make one AirPods, the cost will be, let's say, the cost of making AirPods. I'm not talking about the price. The cost of making AirPods would be, let's say, $50. Now, if I make two AirPods, it'll be $100. So if you make one, it's less. The cost is less, $50. If you make two, it's $100. So flexible budgeting looks at the unit produced, the level of output, because your cost will vary with level of output. Okay. So you look at that. So your marketing budget is 30 lakhs. Next is 20 lakhs. Probably the output is less. For that, everything is less. So they look at output. Depends on the number of output. Depends on the number of products that you produce, number of items you produce. Now, it's common sense. Costs will be higher if you produce more. If I make 10 AirPods, my cost may be $1,000. If I make 5 iPods, it'll be $500. Depending on that, it'll be I will segregate my marketing budget and other budgets. Costs will be lower if you produce less. Okay, and this is known as flexible budgeting, where the budget is flexible. It goes up and down depending on the number of products produced. It depends on how much unit you make. Okay. And it's kind of motivating to the managers because, when costs are high or low, it can be a very difficult situation because managers are always under scrutiny. Their jobs are at risk. If you don't meet the targets, if your costs are high and revenue are less, they may lose their job. They have targets to fulfill. So there we go. So it is motivating for managers, and they will not be criticized if you have adverse variances, if you don't meet the target, if you have negative figures. Let's say your target was to control the cost till $1,000, but it went up. There won't be negative effect because it depends on the number of unit. It's also more realistic because when you produce more, your costs will be more. It's more realistic, right? So that's why it's motivating for managers, and managers like it because it has more of a realistic approach. It looks at number of items, number of products produced in a company. Okay. And again, to make it more clear, if you make 70 books, if I make 70 of these books, let's say the cost is 30,000 taka, and if I make 100 of these books, the cost will go up 42,000 because I made more, and the cost is more. The revenue will also be more because now I will be selling 100 books instead of 70. So it's going to balance out, and I feel it's a very good, realistic approach here. So right now we talked about different things. Now in this world, there are many different ways of doing things. So you can create budget in 3 different ways, which is mentioned in our syllabus. Number 1 is incremental budgeting. Remember, we talked about it. Okay, increment. You look at the external situation. You look at the past budget, but then you look at the external situation for the coming year, for the present year, and you make a budget. You look at zero budgeting, okay, where you try to minimize cost. Right, so that is zero budgeting. And then you have flexible budgeting where you focus on the number of units produced, right? So there are 3 ways of budgeting, and we've talked about all those 3 ways. If you guys have any questions, any comments, please do not hesitate to comment down on the comment section. So, however, there are limitations of budgeting, and we will have a look at the limitations of budgeting. The first limitation is lack of flexibility. Now, when you have a budget, it's written on a hard stone. It's quite difficult to change. There may be unexpected changes, like we never thought that pandemic could happen. So the budget for all the companies for the next year would change. Also, sometimes budgets are unrealistic. Okay, so there you go. And costs may increase. There may be appreciation, depreciation. There may be a lot of things that are unplanned. Now that may not be reflected on the budget. So budget or any kind of account is not so flexible. There's lack of flexibility. Whenever something will change, you will have to review your budget. Okay, so that's problem number one. Now, problem number two is it focuses on the short term, which means, let's say you want to reduce the size of the workforce because the pandemic is hitting everyone hard, and you need to control cost. But then what happens if you get an order, an urgent order? You have 100 workers, you have minimized it to 50 workers. But now all of a sudden, if you have an urgent order, how can you fulfill that? So budget looks at the cost only for the short term. But what happens in the long term? Okay, so just to stay within the budget, managers may take decisions that may not be appropriate for the long term. They may lose focus because they will have a horse blinders on, and they will just look at the current scenario. Okay, um, that is that. Um, Right. So that is disadvantage number two. Moving to disadvantage number three may lead to unnecessary spending. Let's say you've made a budget and the budget has come to an end in December, but let's say still you have some money left. Let's say 5 lakhs of money is left, and you may spend it because since it's left, you may spend it unnecessary because you know that that money is left, and you may spend it unnecessary for no reason. So it may lead to unnecessary spending decisions. Okay. Number four, not everyone is an expert to create or to make budgets. So training must be given to people. Okay. 100% training needs must be met. You need expertise. You need the right people to make budget, to predict what's going to happen in the future, to control costs. And training can be expensive. Okay, you may have to send them to a college, you may have to send them to a university, or call someone externally to train your employees. Okay, and then setting budgets for new projects is it's painful. Let's say you're making a new bridge, so you need to make a dedicated budget for that bridge, and that budget may change over time, because you need to set realistic budget. You may need frequent revisions. It can be a mess. So it can be difficult. So the first problem is lack of flexibility. The second problem is it's focused on the short term. The third problem is it may lead to unnecessary spending. Yeah. The fourth problem is you need to train the people who looks after budgeting, and then setting budgets for new projects is difficult, is painful. Okay. Now we have, this is a very easy topic. If you have any question, do not hesitate to comment down on the comment section. Right. Let's go ahead. There we go. Now, variance analysis. So because when you set a budget, you have a target and you have an actual performance. So you have to see that how did you do in predicting the budget? How was your original target and how was your actual performance? So when you analyze that, that is variance analysis. Okay. For example, the projected cost for, let's say, my rent for this month is £1,000, and the actual cost is £1,000. So I was accurate in predicting. This was for the phone bill. My actual target was to spend 54 pounds, but I actually spent 100 pounds. So there is a minus negative variance, 46 pounds. So why? Why was there a negative variance? I have to go and check. What is the reason? What did I do? Did I make a lot of international calls, direct international calls, or was I traveling? Did I use my roaming, or did the cost go up, or did someone else use my phone? Go and check it. It's not only for negative variances, also for positive variances. I wanted to spend 23 pounds on maintenance or repairs, but I ended up spending zero. This also means that I'm not good at predicting. So I have a surplus of 23 pounds. So why did that happen? Yes, it's good, but then it also shows, on the other hand, that I'm not good in predicting. I predicted that I was going to spend 23 pounds on maintenance and ended up spending 0 pounds, 0 pounds for maintenance. That, which is good. It's a favorable variance, 23 pounds, but then it also shows that I'm not efficient in predicting. I may not be a good manager. Okay. So you need to do this kind of variance analysis, and this is variance analysis where you compare, okay, what did you predict in the beginning and what actually happened, and look at the differences. If the difference is vast, if it's negative or positive, you need to understand the reason, unlock the reason. Okay, why was it negative or why was it positive? Because so that you are more careful in the future, so that your prediction in the future can be better. Okay, so budgetary control, variance analysis, it measures the differences. Okay, you have your prediction, you have your actual performance, targets and actual performance, you compare it. That's your variance analysis. Okay, it analyzes, it looks at causes of deviations, that why was it high, sorry, why was it high? Why was it low? Why did we have a negative figure here in the first place? Why did we have a positive? So much of difference here. Okay, it looks at those reasons. Okay, analyzing those deviations. Lower sales, higher cost. Okay, um, and when you analyze that, your future budgets will be more accurate, and you will be you'll be a better in prediction, you'll be a better manager, you'll be a better accountant. Right now, what does adverse variance mean? Adverse variance mean, now adverse variances means a negative figure. We saw that negative figure, right? So if there is something negative, it's very easy. You have to assume that your sales were less. When you have a negative figure, let's say you wanted to spend 54 pounds, you spent 100 pounds. So negative 46. Probably your revenue was less. Okay, you did not earn so much, or your selling price was less, or your costs were higher. And there are different kinds of cost. Your cost of raw materials may go up. Okay, let's say cost of labor cost went up, or your overhead costs increased. So there can be two things. Probably your sales revenue was less, or selling price was less. Sales revenue in totality was less, or selling price for each product or each unit was less, or your costs were higher. And of course, there are different kinds of costs, like raw material cost, labor cost, overhead cost. Okay, they were higher. And that's why they will lead to a negative number. We saw that if I go back, this was negative. Phone bill was negative, probably because of some of these reasons. Okay. Now, now in terms of favorable variances, you may have a favorable variances. Now, it's just the opposite of adverse variance. Probably your sales revenue was high, or selling price per unit was high, and the costs were less. Raw material costs were less, labor costs were less, overhead costs were less, or there was no competition. Let's say your competition was not as good as you. Okay, so that's why we have favorable variances. We have some definitions here. Okay, look at the definitions. I've already told you what's adverse variance is. favorable variances. Adverse variance means negative. Adverse means bad. Okay, negative. You will have negative figure when your actual figure is less than your budgeted figure. Favorable means good when your actual figure is better than your budgeted figure. Okay, and you need to respond to it. If it's bad, of course, if it's adverse, you need to respond to it. You need to see what happened, why it's negative, why were your sales revenue low, or is the selling price low, or is your costs are really high. Control it. Even if it's favorable, you need to look at it. You need to look at it because let's say you were not good at predicting, something went wrong. Yes, it's good for you, but then you were not able to predict it in the right way. So look at that as well. But then, of course, sometimes there may be cost variations because of an increase in output. Okay, and that is an exception. If you make 70 books, your cost will be 30,000. Same example, if you make 100 books, there'll be 42,000. There'll be a rise in cost. So please see the number of products produced and then try to understand the cost. Okay? Right. So we've talked about that. Let's go. Do we have anything else? Yeah. Um, we've talked about this. Okay. So budgets and budgetary control and evaluation. Now, setting budget, agreeing, controlling budget is very time consuming. Sometimes budgets can change because the external environment changes. Okay. All the budgets needs to be approved by discussion. You will have a board, you will have a limit on how much you can spend. Okay. So think about that, right? And then taking so much of pain, is the process worthwhile? Think about it. Okay. And then you need to have a detailed coordinated set of plans. You need money and resources, right? You need a full planning. And who gets what? How do you divide the budget? That's also a second concern, right? And then you need to have a proper sales budget. So how can you have a proper sales budget? So think about that. You also have to look at individual departments. Then assess the performance of managers. Um, how are you going to compare? Because there's so many figures. So think about that too. Um, of course, you need the right figures. There may be changes. You need to review the budget. Okay, you need to see where the business is going. Suggest changes. Right. And of course, budgets need to be agreed. It needs to be controlled. It needs to be reviewed. It can change. Different people have different opinions. So yeah, there we go. So we have successfully wrapped up the chapter in 30 minutes. There was a lot to do, but I'm quite stunned that we finished it so quickly. Okay, so today we spoke about a lot of things, and I want to, just review it a little bit because it's very, very important. So we want to go right first slide, and we want to talk about everything again. So we talked about three kinds of budget. Incremental budget. Incremental means you look at the situation and then change your budget. You look at what happened in the past, but then for the future, you look at the situation. Okay, for zero budgeting, you try to minimize cost. That's how zero budgeting happens. Okay, just give me a second. That's how zero budgeting happens. And and for everything you need to justify, okay, why do you need 20 lakhs or why do you need 5 lakhs? And then flexible budgeting, it depends on the number of outputs. If your number of output is less, the cost will be less. If the number of output is more, costs will be more. Okay. Then we talked about potential limitations. I think there are 6 limitations: lack of flexibility, Focus on the short term goals may lead to unnecessary spending. Let's say at the end of the budget you have 3 lakhs. Okay, we don't need this, we don't need a new computer, or we don't need new t-shirts for the offices, but still we will order because we have spare money left. Then trainings training is required because people making budget they need to know what they're doing. They need to be an expert because they will be predicting things. And of course, setting budgets for new projects are difficult. Let's say you have to set budgets for building a bridge, and that may be difficult. Costs may vary. Different people may give you different estimations because of external situation. Things may change, right? You need frequent revisions because building a bridge it's not like you're making a piece of furniture. It's huge. Okay, so yeah. And then we talked about variances, the change, like you've predicted. Okay, there's this target prediction, and then you have actual performance. You need to look at the difference. You have adverse variance, where you've predicted, but then it was low, right? Actual performance was low. That's adverse, negative. And then you have favorable variances where you predicted less, but you had more, and that's favorable. And you need to know adverse or favorable because you need to go behind and see why we had a negative figure or why we had a positive figure. Even for positive figure, you need to look at it because here we have a difference of 23 pounds. That means the manager was not experienced enough to predict the situation. Okay, so his or her guess was absolutely wrong. So you need to look at that. Okay, you need to have a clear, in-depth understanding of the deviations of the change. Why did it change? Why did it increase? Why did it decrease? And it happens because of many reasons. Adverse variance happens because of many reasons. We just talked about it. Okay, your costs may be higher, or your sales revenue may be lower, right? And there are different kinds of cost: raw material cost, labor cost, overhead cost. I'm repeating again for students. Okay, pay attention. And then favorable variances. It happens because your sales revenue was high, you were selling a lot, or you were selling a lot in higher price, or your costs were lower. Again, there are 3 different kinds of cost: overhead, labor cost, and raw material cost. Um, Definitions are there. Please have a look at it. Okay, and responding to variance analysis is important. Okay, examples, and then an evaluation. It was a fantastic lesson, everyone. Thank you for being so patient. I know I talk a lot, but it's for the students. It's a bad situation out there. We really cannot open our offices. Students are struggling. Exams have been canceled. So I really want to help students. So yeah, there we go. All the videos will be uploaded on YouTube in 3 or 4 days. So check our YouTube channel. Do not forget to like our page on Facebook, okay? And do not hesitate to send us any feedback, any comments. We are trying to improve every day. Sometimes I take too long to prepare a class because, see, this kind of slides, this kind of detailed lecture takes a long time to make, and I want to help you in the best way I can. Thank you very much. I will sign off right now. Thank you.